are in listen-only mode.
Good afternoon and welcome to the webinar hosted by Sustainalytics and the Investor Responsibility Research Center Institute on a new report, How Investors Integrate ESG, a Typology of Approaches. Our agenda for the webinar is as follows: logistics and introductions, an overview of why this research was commissioned, an in-depth review of the methodology, typology, prevailing types, and market observations, some concluding words, and then we'll take your questions. In terms of the logistics for the webinar today, all attendees are in listen-only mode, but we do encourage your questions. Throughout the sessions, if questions happen to pop into mind, you can type them into the question box on your control panel. You can see that on number 1 on the image on the right-hand side of your screen. Just type in your questions, and following the presentation, we will read those questions aloud and respond to them. This session is being recorded, and a replay along with these PowerPoint slides will be posted by tomorrow on www.irrcinstitute.org. We encourage you to share information about this report and webinar. Our Twitter handles are @IRCResearch and @Sustainalytics. If you have any audio issues during the webinar, please call GoToWebinar at 1-800-263-6317. We have 3 speakers today: John Lekumnick with the IRRC Institute, Kevin Rainey with Sustainalytics, and Doug Morrow with Sustainalytics. John has served as the Executive Director of the IRC Institute since its founding, and along with the Board of Directors, he's led the organization to become a leading source of objective academic and practitioner research on an array of investment issues. He has decades of experience as an institutional investor, including time as the investment advisor to the New York City pension funds. John also is the author of the new book, What They Do With Your Money, How the Financial System Fails Us and How to Fix It, published last year by Yale University Press. Kevin Rainey is a Director of Product Strategy and Development with Sustainalytics. He's been the Director of Product Strategy and Development for the past with Sustainalytics, and he has 20 years of experience in the field of responsible investment and corporate sustainability, and has worked with a wide variety of asset owners and investment managers, helping them to incorporate ESG considerations into their investment policies, strategies, and processes. He's an expert in the development of metrics and methods to evaluate sustainability performance and has led numerous projects involving the development of custom frameworks and metrics to measure ESG-related risk and impact. Doug Morrow is the Associate Director of Thematic Research at Sustainalytics, managing the firm's thematic research products, including ESG spotlights, sector reports, and thematic notes. Doug's work is focused on evaluating macro investment themes and cross-cutting investment risks and opportunities, including those related to climate change, global energy transition, water scarcity, data security, community relationships, and corporate transparency. Before joining Sustainalytics in 2014, Doug worked in senior research roles at Corporate Knights Capital and ICF International and Innovest. Just a couple quick words about the IRC Institute if you're not familiar with the organization. It's a nonprofit established in 2005, and essentially what the Institute does is it funds and disseminates objective, unbiased research on a range of issues important to investors to help the investors and other stakeholders make informed decisions. We sponsor an annual research award with 2 $10,000 awards. We encourage you to check that out. The deadline for our submissions is October 6th of this year, and there are more than 60 research reports available at no charge on the website, irrcinstitute.org. And Sustainalytics is a global leader in ESG and corporate governance research, ratings, and analysis. It has 13 offices around the globe with more than 300 staff members. Coverage includes a universe of more than 6,500 global equities and over 300 institutional clients in 22 countries. And with that, I'll turn the presentation over to John Lekumnick with the IRC Institute. John?
Thanks very much, Kelly. I also want to thank Kevin and Doug and all of Sustainalytics for the report. I just want to take a minute to set the stage here for why we commissioned the report. For decades, many of us have suggested that ESG factors matter to the bottom line. And in more recent times, that has gone mainstream. There is $22.9 trillion of assets under management. managed with some type of ESG analysis. Many managers now utilize ESG analysis for many reasons. For some, it's a source of alpha. For others, it's important risk control. Some use it thematically to define fishing grounds, for instance, looking for investment opportunities around water scarcity issues. And for some, it's a deep analysis of individual companies to understand how they are reacting to threats, such as transition to low carbon economy, or opportunities, such as transition to low carbon economy. There are business reasons as well that ESG integration has gone mainstream. For asset managers who rely on RFPs from asset owners, many of those asset owners are now including questions about ESG in their RFPs, and people are increasingly looking at how the managers manage those factors in making their hiring decisions. It's also a factor in something that people in the industry talk about, but people out of the industry don't, which is attracting good talent, particularly young talent coming out of school. A number of analysts and PMs and other folk in the business care about these issues, and they want to work at companies that care about these issues. So the result is that now 22.9 trillion, which represents innumerable investment firms and asset owners, claim to integrate ESG into their investment process. And this is a webinar, so you can't see me, but you can imagine that I made the air quotes around integrating ESG, because the problem that we perceived is that the phrase ESG integration had become a meaningless mantra. It had limited descriptive use. Next slide, please, Kelly. It's been used as a catchphrase to mean anything from really deep analysis, taking into account the risk and opportunity factors and thematic factors and system feedbacks at every level of the investment decision, to plain old greenwashing. We say we do it, we name a couple of things, we sign the PRI, and we go away. And for asset owners or for beneficial owners who are looking to understand what investment managers really do, that created a frustrating system. When a fundamental equity manager tells me I'm a bottom-up fundamental small cap value manager, I have a starting point for doing my due diligence and understanding its investment philosophy and its process, and I have something to judge it against. Whereas if a manager just says I integrate ESG, that's not nearly as helpful. Even sophisticated beneficial owners get confused. I've been having a dialogue for a couple of weeks now with the CIO of a $60 billion trust. Even he expressed sort of frustration at the fuzziness of how managers integrate ESG. So the IRC Institute issued an RFP for a typography of how managers do integrate ESG. And the instructions were for the research provider to be granular in its findings. Who integrates ESG at the firm? What is it that's integrated? How is it done? In fact, I wanted to be so granular that what I told Sustainalytics after it won the bid was, if I were starting an asset management firm, what are the decisions I have to make to know how I would integrate ESG into my portfolio? Next slide, please. So as I said, we put this out for bid. Sustainalytics won the bid, and I think when you read the report, and I do urge you to read the report, it's available free of charge at ircinstitute.org, you'll agree they did a good job. We don't believe, and Sustainalytics doesn't believe, it's the final word on the subject, but Sustainalytics has developed an analytical framework that is both useful for understanding exactly how asset managers integrate ESG and can be built upon in the future, or by individuals on this call who want to take this basic framework and add to it. The typography fundamentally provides the equivalent of a style analysis. And as you'll see, Sustainalytics has also identified leading styles of ESG integration: the believer, the statistician, the cautionary, etc. While in the few weeks since the report's released, those categories have received a fair amount of attention, they are the fallout of the analytical framework, and as important as they are, and as interesting as they are, it is the analytical framework itself that I think is more fundamental. By the way, since we've released this, I've been amazed by, well, actually I haven't been amazed, but I've been pleased by the response to the report. It's been extraordinary. I've received more than 100 comments with literally 99% of them positive. It seems I wasn't the only one frustrated by the lack of clarity around the phrase ESG integration. And I'm very pleased that the investment community has recognized the utility of having a strong analytical framework through which to analyze that phrase. With that, let me turn this over to Kevin and Doug to walk us through the findings. Kevin?
Great, thanks very much, John. That sets the stage really nicely, and thanks to all of you out there for joining us today. We're really pleased to have had the opportunity to collaborate with the IRC Institute on this project, and to be presenting the outcomes today, and hope that this typology will indeed serve to clarify conversations about what ESG integration means in practice, and help investors navigate the ESG space, especially those relatively new to it. We see that this typology as building on the past work of others, most notably the PRI, which has put out a number of reports, including a recent report that provides a very extensive inventory of examples of ESG integration techniques in public equity investing. In this case, with this project, we've aimed to really home in on the essential or key differentiators between the integration approaches that we see in the market, while also encompassing a broader range of variables, including organizational and process-related aspects of integration, and then to use all of this to build a typology. It's a typology that doesn't capture all of the details or all of the nuances, but does provide, we hope, a good map highlighting the key differentiators. Our aim is to identify and to classify, not to pass judgment. So we don't say which approach we believe to be more effective or to lead to better results. Next slide, please. So a few notes on methodology. The typology assumes what I think is the prevailing definition of ESG integration, which is the incorporation of material ESG factors with the aim of enhancing returns. A quick note, related to this on screening or filtering, which is a practice carried out by numerous investors that integrate ESG. We treated screening as a technique of integration if it was at least in part motivated by an investment case, as opposed to being solely motivated by the goal of complying with norms or managing reputational risk. With regard to the scope, one important note is that the typology focuses on portfolio management itself, and so it doesn't consider activities such as engagement, which for many plays an important role in informing their investment analysis. But yeah, we opted to keep the typology focused on the structures, the processes, the methods involved in integrating into portfolio management. So we began our process with the development of an initial analytical framework that included 18 indicators that we used to structure our research. This framework was informed by the PRI reporting framework, as well as our in-house awareness of integration practices in the market. We then looked at the practices of 70 investors, almost all of which are PRI signatories, reviewing transparency reports and conducting interviews with half of them. And that sample that we selected we were aiming to include a wide cross-section of the market and diversity with respect to size, geography, position in the market, and so on. Most of the investors in our sample are focused on listed equity. There's some fixed income as well, and most are active, but there's a fair bit of passive in the mix as well. And then one final methodological note, the unit of analysis for the typology is the approach taken by individual portfolio management teams, as opposed to whole firms or organizations. And so this means that with some investment management firms, especially larger ones, there may be multiple approaches in place, and this is certainly something that we observed. Next slide, please. So here at a high level is the typology that emerged from our process. It has three core dimensions, and they are, in short, first, how ESG-related functions are organized and managed. In other words, who is integrating ESG. Secondly, the nature of the research and analysis that is being integrated. In other words, the what of integration. And thirdly, application, which addresses what kinds of techniques are being employed. So that is the how of integration. Within each of these dimensions, we identified two key differentiators, and then use them to build the typology. So in the next three slides, I'll delve in more detail into what is in each of these dimensions. So management, again, is about how the various functions and roles related to integration are organized and managed. And the first key differentiator here addresses the degree to which these functions and related responsibilities are centralized. And there is very much a continuum here, as there is for the other differentiators in the typology. At the centralized end of the continuum, you're likely to find dedicated ESG personnel or specialists or teams who are carrying out research or analysis, say materiality analysis, that they then pass on to the portfolio managers. And at the other end, in a fully decentralized approach, there are unlikely to be dedicated roles. Responsibility lies fully with individual portfolio managers to integrate in whatever way they deem appropriate. The second key differentiator for this dimension is focuses on whether there are processes or mechanisms in place to ensure that ESG factors are integrated. And here, when I say are integrated, I don't mean that they necessarily alter the outcome of a decision, but that they are at least considered in the process. So this might involve, say, a requirement that portfolio managers document if and how ESG was considered to be material and incorporated into each decision. And there are numerous other examples in the market of such mechanisms. And so, as is the case with all of the dimensions, the two key differentiators are independent of each other. So a given approach can be classified in one of the four quadrants that you see in the graphic here. So a few key findings to note here. We heard differing views on the pros and cons of centralized versus decentralized structures. It was interesting to hear from some of the interviewees who are more centralized that while they see the role of ESG specialists as being very important, they also aim to move toward less centralization, seeing this as a better way to really embed ESG into the daily work of portfolio managers. We also heard differing views regarding the necessity and effectiveness of mechanisms to ensure that integration takes place. Some view these as important in order to ensure consistency. Others see them as unnecessary and in fact assume that a good portfolio manager will figure out what is material and consider it anyway. But related to this, we heard that from some interviewees that creating a team culture that recognizes the value of ESG integration is probably the most effective way to make sure that it happens. Next slide, please. So the second major dimension is research, which considers the type of ESG information and analysis that is being integrated. And the first differentiator here is the breadth or the scope of the research. And we consider it to range from narrow to broad. By narrow, we mean research on the ESG relevant characteristics of individual companies. So metrics around governance or health and safety or a whole broad host of other areas of performance. In contrast, by broad research, we mean not only company level information, but also information and analysis of macro or thematic trends that may interact with the company specific factors and influence value. And examples include analysis of stranded assets risk, trends around water scarcity, demographic changes, etc. The second key differentiator here addresses if and how data inputs used by management teams are modified internally. So are data or scores from external providers taken as given? Or does a team have a process to modify externally sourced data or research using, say, an internal scoring model, or a process to select certain metrics in line with in-house materiality analysis? So in terms of key findings here, we heard a growing recognition of the importance of using broad research, that is research that includes the broader ESG trends. And yet in practice, when it comes to ESG at least, many are not integrating at the macro level or considering its potential materiality. We heard from a number of interviewees, not surprisingly, that it is really challenging to quantify these things, to quantify the expected effects over time of macro level ESG issues, especially given the systemic nature of these issues. So this is a really challenging area and one that's very much under development in the market. Second observation is that those that are doing customized analysis using in-house tools, modifying data, carrying out materiality analysis systematically, they're generally inclined to want to carry out modification of whatever inputs they use in their in-house analysis. Next slide, please. So application is the third dimension. This one focuses on the question of how investment teams apply ESG information in their processes. The first differentiator is about if and how top-down techniques are used, and the second is if and how bottom-up techniques are used. Now these are separate and independent. In other words, both can be practiced. It's not either or. Now, it's important to note here that the definition of top-down in this typology is a bit different from how it's often defined. So I'll try to clarify. Top-down integration involves the development and execution of an investment thesis that's based on a general view of how ESG factors may create investment risks and opportunities. This is as opposed to a very company-specific view that is derived from fundamental analysis. So top-down techniques are usually rule-based, although they may also involve taking a general view on an industry or on a business model as a whole. Examples include filtering a universe or reweighting an index based on material ESG factors. And this is there's various techniques that can be applied both to active and passive strategies. In contrast, bottom-up integration is the integration of ESG into security-specific fundamental analysis, using ESG, for example, to adjust the discount rate in a model. And again, there are various techniques in use in the market. And I also want to highlight here that that top-down and bottom-up techniques can both incorporate both narrow and broad research, as we defined it under Dimension 2. So couple of observations here. One is that screening or filtering a universe is certainly one of the more common top-down techniques in use. And the rationale is generally grounded in an investment case, although it's also often seen by a number of interviewees that we spoke with. It is seen as having value from the perspective of mitigating sustainability impacts as well. And indeed, some see these two rationales as converging and as being well aligned, especially given the systemic nature of the way in which many ESG issues will affect value over time. Then a second finding here is that the goal of limiting tracking error is experienced by some as a constraint on ESG integration, especially with respect to integrating a longer-term view of on the impact of micro or thematic trends on certain sectors. So that's an overview of the typology itself. I'll now pass it to my colleague, Doug.
Thank you very much, Kevin. So in addition to developing the typology itself, we were also interested in identifying what we call the prevailing types of ESG integration in today's market. And our task was really to look at all the various permutations that were yielded by the typology and identify those that were not only generally well represented in our sample, but also distinctive in terms of their overall position in the market. So as you can see in the slide here, we landed on 6 distinct prevailing types of ESG integration. And you can also see on the slide the pathway through the typology to get to each of these prevailing types. Now, as we said before, while it's often difficult to bucket investors into any of these prevailing types, particularly as many are, especially the larger shops, are often simultaneously running multiple approaches, I think the main value out of these prevailing types is they really help shed light on important differences that investors are taking with their approaches to ESG integration, and they also help characterize the diversity that we're seeing with investor practices. So what I wanted to do was to quickly go over some of the key findings from each of these prevailing types, which I'll do now. So if you can go to the next slide, please. Thank you. So the first is what we call the believer. Now, this is a type of ESG integration that really involves a clear structure and a consistent approach across an organization. Now, notable features are the use of top-down techniques, such as taking a general view about how ESG risks or opportunities may play out in the market, as well as narrow research. So an example of what that looks like in practice could be underweighting portfolio companies with a worst-in-class ESG score, for example, something like bottom 5% of the industry. Now, as we'll see, like the cautionary and the statistician, The believer centralizes ESG responsibilities and has a process to ensure that ESG factors are considered in the investment process. The next slide, please. So the second is the cautionary. Now this type is distinguished by the use of bottom-up integration techniques, such as adjusting cash flow projections or a discount rate used in a DCF, as well as narrow ESG research that is largely unmodified. So that would include things like overall ESG scores or company scores on individual metrics like energy intensity. Integration methods here tend to be a little bit less systematic than those of the believer, although as you can see on the slide, the cautionary still has a system in place to facilitate and support the actual integration of ESG information. So the next slide, please. So with this one, as the name implies, the statistician is really focused on quant analysis and unearthing statistical relationships between ESG and either firm level or portfolio level financial performance. Now, unlike the believer and the cautionary, this type is characterized by modified ESG inputs, which is, as Kevin said, refers to external ESG research that is then augmented with in-house analysis, such as factor weights or things like that. However, like both the believer and the cautionary, the statistician uses a centralized approach to ESG management, such as ESG specialists who sit either outside or within investment teams, and it has a process to ensure integration. Now, the statistician is also noteworthy because it's likely to encompass most passive managers. If we can go to the next slide, please. So the discretionary, so this type is unique among the 6 prevailing types in that it's the only one that lacks a process to ensure or encourage the uptake of ESG research into investment decision-making. You can see that show up on the slide under the management dimension. And coupled with the use of unmodified ESG inputs and application that's neither focused on top-down or bottom-up techniques as we define them, this type generally reflects a lack of conviction about the financial value add of ESG integration. And teams taking this approach usually, for instance, do not have an organizational view on how ESG factors may affect value. And PMs and analysts typically have a lot of latitude to determine the relative importance of ESG research or whether to use it at all with this type. So the next slide, please. The transition focus. So this type is in many ways the polar opposite of the discretionary. So hallmarks here include decentralized ESG management, the use of broad ESG research that is then modified with in-house data and analysis. And as you can see on the slide, a combination of both bottom-up and top-down integration techniques. So what does this look like in practice? It could include things like a structured assessment of macro themes like water scarcity, climate change, the shift towards healthy eating, for example, or underweighting fossil fuel companies based on stranded asset risk. And while this characteristic in some way lives below the typology, approaches that fall into this type are typically associated with a high degree of conviction on the part of PMs and analysts about the potential of ESG information to add real investment value. And ESG is often a central part of a firm's culture in this type. So the next slide, please. So the final prevailing type is the fundamentalist. And as you can see on the slide, it's broadly similar to the transition focused, but it is distinguished by greater emphasis on bottom-up techniques, such as scenario analysis to forecast the possible outcomes of an ESG event or controversy like a pipeline spill, or considering how companies might stand to be affected by a carbon pricing. Now, along with the transition focused, this is the only prevailing type where ESG responsibilities rest with investment teams as opposed to a dedicated ESG staff. So to summarize and build on what we said earlier, not every investor will fit perfectly into these 6 prevailing types because the typology, like any analytical framework, is a simplification of reality. But we do hope that this analysis provides a new tool and vocabulary to help the market make more informed sense of how investors are approaching ESG integration. So for those of you who have seen or read the report, you'll know that we closed out by offering 5 high-level observations about the state of play in the ESG integration market. Now, not all of these observations are actually expressed in the typology or the prevailing types, so we really present them as general findings from our research and interviews. So I wanted to quickly go over those now before concluding and getting to the Q&A. So the first observation is simply that it's actually quite difficult to know precisely how much ESG integration is actually going on. And what we mean by that is this is partly due to a lack of conviction about the risk-return benefits of ESG information on the part of individual PMs and analysts at organizations that have expressed support for ESG integration, for example, by signing the PRI. Now, coupled with the lack of reporting mechanisms at many organizations, as we discussed earlier with our Dimension 1 analysis, it's clear that many investment teams are not fully utilizing the ESG research that they have access to. But on the other hand, it's quite possible that genuine integration is taking place at organizations that have not publicly expressed support for ESG, for example, again, by signing the PRI. So the main takeaway here is simply that depending on how high you set the bar, it's actually quite challenging to figure out and determine how much integration is actually going on. The next observation is, again, this builds on what Kevin touched on earlier. It's really that meaningful ESG integration can still be challenging. So despite the surge of interest that we're seeing from investors and, as John alluded to, the significant growth in global AUM that incorporate ESG factors, many interviewees expressed the view that genuine integration can still be quite challenging. And many, interestingly, singled out the practice of bottom-up techniques. So things like adjusting a company's projected cash flows or discount rate based on ESG performance. Many signaled these practices as being particularly challenging. So even though, for those of you, again, who have seen the report, we describe in detail several innovative examples that fall into this bucket, it's clear to us that this this practice is still very much at an early stage in the life cycle. So thirdly, concerns about ESG research, which powers a lot of the integration market, they were fairly widely documented in our research. Many interviewees signaled concern about things like research timeliness, transparency, and coverage, geographic coverage, especially around emerging markets. Now, of course, as we all know, many of these concerns reflect the relatively brief history of ESG disclosures. And also, many interviewees cited that there's been a notable improvement on many of these measures in recent years. But nevertheless, to us, this really shows the importance for users of ESG data and research to triangulate, where possible, ESG performance data and to corroborate with different sources of information. A fourth observation, again, this builds on something Kevin touched on, relates to tracking error constraints. So several managers were quite candid with us and indicated that tracking error limits set by asset owners are really constraining the extent to which they can incorporate ESG information into their portfolio strategies. And this, in many ways, this observation is similar to the long-time complaint by fundamental managers that tracking error limits mean that investors want active management, but not too much active management. So I think there's a parallel there. And to us, what this means is that more empirical testing of ESG data and research is needed, including testing things like expected impacts on portfolio volatility before such constraints are ultimately relaxed. And then a final observation is simply that, for many investors, the line between, on the one hand, maximizing risk-adjusted returns, and on the other, minimizing corporate, social, and environmental impacts is really blurring. Many interviewees talked about an investment case for aligning their holdings with the broader goal of creating a sustainable economy, particularly in light of renewed talk about the importance of integrating a systemic perspective into investment decision-making, an argument that's been made by many bodies, including the Investment Integration Project. Thank you. So with that, I will just conclude by saying once again that we hope the typology and the prevailing types that we presented in the webinar and in the paper, we hope they provide a flexible analytical framework that investors and other stakeholders can use to organize the growing diversity of ESG integration techniques that we're seeing in the market. We also hope it promotes discourse and discussion. And of course, as investors' interest in ESG continues to mount, it'll be interesting to see if any of the key differentiators that we identified start to shift over time. So that's also something that we intend to monitor going forward. So with that, I'll pass it back to Kelly.
Thank you so much for the in-depth presentation. And now we're ready to move on to the Q&A portion of the webinar. And just a reminder, if you have questions, there's a question box on your control panel. You just type your question in there. We'll read it aloud and we'll respond to your questions. It looks like we have several in the queue, so I'll just start reading those off as they come in. The first question, is there a better way to integrate? Is there a study to determine the best way to practically integrate? Any studies done to categorize managers into these sleeves and then score their risk/return?
Well, I'll get started, I guess, just by clarifying that I mean, there may be, I mean, certainly some work has been done in that area. Those questions were outside the scope of what our project has been about, though. As I noted at the outset, this typology aims to provide a map to navigate ESG integration, but doesn't aim to judge approaches or to say which will lead to better results. So yeah, that's a question for other studies.
Thank you. Our next question, would you anticipate any changes to Morningstar's sustainability ratings and or process as a result of typology research?
No, I mean, not as a result of this work. I mean, it's that methodology is doing something different from what this typology is about. I mean, this is about how ESG integration is practiced by the managers of assets, whereas the Morningstar rating is about turning company ratings, in this case ratings produced by Sustainalytics, turning them into a fund rating. So yeah, I'm not seeing how this might impact that methodology.
Thank you. Our next question, what was the percentage breakdown of the 7 categories?
Yeah, I can respond to that. That's actually something that we didn't get into in the report for a few reasons. One, I think most importantly, the challenge with doing that type of market sizing is that, as we said, many investors are in fact running multiple approaches simultaneously, especially at the larger shops. So this was a bit of a disconnect between our unit of analysis and bucketing investors into any one of the 6 prevailing types. And then another reason was research. So we found, especially with the 35 investors that were subjected to desk-based research only, there were some research gaps there that made it difficult for us to bucket them into any of the 6 prevailing types.
Thank you. The next question, from your survey, how do the questions to investment managers differ based on the different ESG quote classifications? Is there a difference?
No, so there wouldn't be a difference. I mean, in every interview that we did, we ran through the same set of questions. Now, I mean, there was some, the interviews were semi-structured in that we ran through a set of questions consistently, but would also, let the conversation go where it wanted to go in some cases. And if there was more to talk, if there was opportunity to talk about passive versus active or fixed income versus equity, then the conversation may have gone in one direction or another. But it was our aim to be consistent in how we approached those interviews and to cover everything we needed to cover in order to place the team that the person was speaking on behalf of place them with respect to each of the key differentiators.
Thank you. The next question, can you give us an idea of the characteristics of the sample on which this study was done?
Yeah, I can respond to that. So as we said with the methodology, the summary, we really sought from the beginning to choose a wide cross-section of the market. That was really important to us from the beginning, to capture as broad a swath of practices as possible. So we looked across investor size, geography, and I think probably most importantly, also experience with ESG integration. So we purposely included some investors that were, in the relatively early stages of their ESG integration practices as well. And I can also say geographically, there was a bit of a tilt towards the US, but we also, with 27 investors from the US, but we also had lots in Europe, 12 in the UK, for instance, 16 in continental Europe, 7 in Australia, 7 in Canada, and 1 in Japan.
Thank you. The next question, to clarify, do the points raised with respect to limited tracking error being a constraint predominantly reflect passive managers' interviews in the study?
No, I wouldn't say it's predominantly a reflection of passive managers. I think in the course of our research and interviews, several active managers expressed that view.
Thank you. The next question, do one or more of the typologies match up with addressing systemic concern?
So I assume by one or more typologies there, you're referring to the prevailing types. And I would say that I think that the transition focused type is clearly the one that is most focused on the larger issues, the larger macro sustainability issues and trends that are of concern from a systemic perspective. I think that one does stand out. I would also say, perhaps to a somewhat lesser degree, the fundamentalist is likely to be taking into account those macro level issues, although usually just in the context of applying bottom-up techniques. But there is certainly some of that thinking there. And then we also see in the believer, for example, I think that perspective reflects some consideration of those kinds of issues, those broader systemic issues, although there may not be the same readiness to build a portfolio around a consideration of those issues in the way that we see in the transition focused.
Thanks. Our next question, sort of related to a previous question. The focus is on North America. Is there a sense that the typology translates to other regions like Europe, where the consideration of ESG is more culturally embedded, or Asia, where it's relatively nascent?
Yeah, I mean, I think, as I said before, with describing the sample, there was a purposeful intent to capture global practices. There was a slight tilt, you could say, towards the US. As I said, there was 27 out of 70 from our sample that were based in the US. But no, I think the typology and the prevailing types capture investor practices globally and can be used, can be applied in a global context.
It's John. I just want to point out one thing. There's an estimated $23 trillion that are managed with some sort of ESG factorial analysis somewhere in the process. Sustainalytics interviewed managers and asset owners who control nearly 20 trillion. Now, those are different data sets, so I wouldn't blindly, say that we have 20 out of 23 trillion represented, but it's a fairly large sample size of assets. Again, not all of those, some of the larger asset managers have both ESG and non-ESG related assets as well. So again, I would not blindly just say that there was 19.9 trillion of ESG integrated assets, but it did include some of the largest investors in Europe and Asia, as well as the U.S. So I would definitely agree. I don't think this really was North American focused.
Thank you. Our next question, I'll just keep ticking through those. It looks like we've got at least another half dozen in the queue. This research appears to be very focused on equity investing. What are the parallels with alternative investing classes, such as real estate and infrastructure?
Yeah, that's I think that's a good question. It's something that we spend time thinking about. So as far as the investors go, I mean, it's certainly the case that most are largely focused on public equities. There were some that obviously had fixed income exposure, but yeah, I would say the alternative asset classes, by and large, lie outside the scope of this project. But I think that's certainly a case for fruitful future research. I mean, we certainly know that ESG integration has long since branched out from listed equity into these alternative asset classes, including hedge funds, infrastructure, real estate, etc. So I think that could be a good research question for the future.
Thank you. The next question, back to the Morningstar fund ratings question. I understand that you haven't done it to date, but might Sustainalytics try to categorize funds based on their ESG integration techniques going forward?
Yeah, that's a question that's a question that we have contemplated and Morningstar has contemplated, and it's also a question that's outside the scope of this project. So I'm not well positioned to say more about it at this point.
Thank you. The next question, can you expand upon the link between tracking error constraints, ESG integration, and performance?
I'll take that one. Investors often want to control their risk relative to something else, whether it's an index such as the S&P 500, the rest of their portfolio in terms of a completion portfolio or something else. But basically, tracking error generally, as you know, refers to the difference in co-movement between your portfolio and a broad market index. By contrast, let us say that, for instance, you looked at broad ESG research in a centralized, non-discretionary way and came to the conclusion that you wanted no fossil fuel exposure, and you would no exposure to that sector at all, which would risk exposures and potentially change your tracking error versus the index. What that does in terms of performance is it totally depends on whether or not your analysis is correct vis-a-vis the market. Obviously, if the fossil fuel sector, if the oil and gas sector performs better than the rest of the index, not having any exposure will result in an underperforming, a materially underperforming portfolio. On the contrary, if you got it right and it underperforms versus the rest of the index and you've invested, you're going to outperform. So the question on performance is more a question of how much differential in performance versus the index are you willing to take. That has lots of ramifications, including things that you might not initially think about. So, for instance, some of the largest investors in the world are defined benefit pension plans. Those pension plans do asset allocation modeling and asset liability modeling based usually on broad asset classes. So if you are going to have a huge discrepancy in performance versus your asset class, you're probably going to have to redo your whole asset allocation to understand what's going on. And so it's frustrating for managers who may have a huge conviction that portfolio that looks nothing like the S&P 500 is a much better portfolio in terms of what that manager perceives its risk and return to be. But the mandates will say you can't differ too much. And I think that's very much, I forget whether it was Kevin or Doug, said it's very similar to a concentrated active manager complaining that the clients say they want active management, but not too much active management. They don't want to be too different from the S&P 500. In this case, managers complain that the asset owners want us to take into account ESG factors, but not so much that we have a totally different return profile from the broad-based indices, and that's what that issue is about.
Thank you. Just a couple more questions. I'll keep running through them. The adoption of ESG benchmark indices seems to be slow. Do you have a view on why this has been challenging?
Kevin, Doug?
Yeah, well, I mean, I think that some of John's comments just now relate to this. There's a lot of weight placed on performance in relation to mainstream benchmarks, and we've certainly seen some use by some managers of ESG benchmarks for used to measure performance of their portfolios, but it's just the way it works in the industry. It's really people look to the mainstream benchmarks, and that's what they're generally what they're competing with.
Thank you. The next question, how long did each interview session take, the average time?
1 hour.
Thank you. That was an easy answer. How can you measure an organization's use of ESG research to say that some of those organizations are overstating what they do in ESG integration?
I'll take that one. It's a due diligence question, really. And one of the advantages, I think, of the analytical framework is that it gives you a map for what true north for that organization is. Again, not for what someone should be doing, but for what that organization says it does. You can then go in and ask, explain to me how company A went through this process, or show me if for instance they say that there is a methodology to ensure the integration that includes a report for the manager. You can ask for a time lagged or perhaps somewhat redacted set of those write-ups. In other words, this gives you a set of processes against which to diligence. If someone says they're discretionary, that sort of by definition says there may or may not be, and so there won't be as much to do diligence against. But I think that what's useful in this framework is it provides a set of questions, and it also suggests a set of documentation that should exist internally to that manager that people can diligence against.
Thank you. Just a few more questions. Will we need ESG integration in the future? That is, won't ESG be integrated into everything investors do in terms of research?
It might be.
That is the holy grail in the theory. There's, to quote Martin Luther King, the arc of justice bends very slowly, but it does bend in the right direction. So I suspect that will happen past my lifetime. Until then, I will continue to ask the questions and diligence it.
Thanks, John. The next question, did any of the interviewees mention if/how they used SASB standards in their integration approach?
I think it came up in a couple of interviews. Some are in fact involved in with SASB directly, collaborating with them, and some are looking at what SASB is producing, looking to incorporate it into what they're doing. But I think it's still early days in terms of actual implementation there.
Thank you. Just a couple more questions. How much did the research explore the concept of material ESG factors? In my experience, there are many different approaches to determining materiality. Did this play a part at all into the development of the typologies?
So we were certainly focused on ESG integration that aims to manage risk, enhance returns, and so on. And that, I would say, by definition, means that we're talking about ESG to the extent that it's material. Now, I would add that what materiality means is a complex question, and especially when we're talking about broader sustainability issues that are systemic in nature, it becomes very, very challenging to delineate what is material and what is not material. And I mean, my sense is that over time, the understanding of what materiality means in practice will broaden to include many of these the broader issues. But at this stage, I think most understand it to be ESG factors that may affect value on a shorter time horizon.
Let me just add, I think this question and the last one about the SASB standards indicates where ESG integration is heading, which is towards some level of sector materiality. That being said, this research did not examine that. We took as given, if you will, the investor's definition of materiality. We didn't try to suggest that they were too broad or too narrow or focused on the right or wrong thing. There obviously is a wonderful set of research out there about what is material and what is not, and what has performance effect and what doesn't. Most recently, George Seraphim's piece on disclosure has gotten a lot of attention. So the questions are valid and good, but it wasn't really the scope of this. This was, if you assume that investors who say they are trying to drive financial performance, by definition, look at material things. How do they do it? Who does it? When does it happen in the process?
And it looks like we have one last question. As so much ESG data is both neither mapped from one provider to another, and that there is a very low correlation among providers' data, how does this highly confused and confusing situation relate to your findings?
So that correlation there, I'm guessing that the questioner is referring to the scores produced by different providers, which and it is the case that I would say they're largely correlated, but there certainly are differences. That's not something that we really examined in what we did. I mean, we were looking more at what are the investors doing with what they get. Now, it's I mean, we did hear that those that are really digging in, especially into fundamental analysis, are often getting research and analysis from more than one provider. They are also, as I said earlier, they're also often not really putting too much weight on those scores, but rather digging into specific indicators and metrics that they have decided are most material. Yeah, I'm not sure if that answers the question, but those were some observations that we took away.
And we did have one more question come in. Let me just throw that one out there, and this I think is the final one. You mentioned in a prior question that the presentation suggests a certain diligence questions and certain documentation the manager should be able to provide. Will you provide those frameworks?
I think the frameworks are in the report. When you read through the three dimensionalities, it suggests how the managers are integrating ESG into the investment process. And so I think that it is fairly easy to develop, or I shouldn't say it's fairly easy, but I think it is possible to develop a set of diligence questions off of those to say, to the managers, so how much of your ESG research is centralized, or what role does your ESG staff play versus your portfolio analytic team? And what's the feedback mechanism that makes you sure that they've considered ESG? Are you looking at broad research, such as stranded asset research, or are you looking at narrow research, such as the risks and opportunities and best in practice, worst in practice for an individual company? And how do you do all that? How do you document it? So I think that's what I meant by it suggests a set of diligence questions and a framework against which one can do diligence. I think that's a useful thing to have. As I said in my opening statement, it's sort of like a style description for a fundamental manager. It lets you know when the manager is sticking to their style, in this case, a style of ESG integration, or deviating from it. And if they're deviating from it, it begs the question of why.
Well, that was indeed the last question, and we thank all of you for those insightful questions, and we thank you for your time this afternoon and interest in the report. Again, this session was recorded. It will be posted on the IRC website by tomorrow, along with these PowerPoint slides. If you do have any follow-up questions, of course, Kevin, Doug, and John are delighted to take those questions. You can see their contact information here. It's also on the website. So again, we thank you for your attention, and this concludes our webinar today. Thank you and have a nice afternoon.